A very good evening to you traders. This is Mark. Welcome to your daily trading video. Okay, this is becoming the central bank trading strategy. It's worked now for probably 4 or 5 central bank announcements. ECB, FOMC, BOE, and kind of works on some of the thicker stocks after earnings. Although I looked at it on Apple, but I must look at it on some others as well. Anyway, the point of this strategy is that you are trading a non-event, or in other words, so not a non-event, an event that really has a nothing result. There's nothing surprising coming out, no one gets surprised, and all you get is this kind of chop, a ping up, a ping down, a little whipsaw back and forth. Looks untradeable, looks like it's catching people out, but actually this is how you can bracket it and kind of generate a trade idea from it. So these are the rules to the strategy. I've talked about this before, but I've kind of crystallized the rules a little bit better. And as usual, not a recommendation to trade, just something I've spotted. If you want to implement it in your own strategy with your own parameters, then please feel free. Okay, so what I've got is I've got a fib retracement. So FOMC comes out 6 o'clock UK time. It's actually 6 o'clock this week, but normally it's 7 o'clock because the clock's changing. And you get a spike up and a spike down. Now, the point is of the strategy, as I say, is you're looking for fake reactions. You're looking to trade against the reaction. Now, if you're good enough to be able to pinpoint the turn on these exhaustions, then obviously that's a more preferable thing. But this is a very systematic way of doing it. So what I'm first going to do is I'm going to put a kind of fib, but it's not. It's like quadrants. It's basically split it up into quadrants. So 25%, 50%, 75%, and 100%. So this is just purely to be able to see each of the sections. So you've got 4 sections obviously in quadrants. So I'm putting that at the top and the bottom, and what you're doing is as the price is spiking, you're just systematically moving it down to find the low. So when that was the low, there's the marker, and when that goes to new lows, you bring it down until you've got a proper high and low marker here. Now the thesis of the trade is that you're pushing one direction or the other, and you're just whipsawing about, and you're going to retest the prior level here or here in vice versa situation at some point. But it's just a way of quantifying it. So the rules are, as you cross over the 50%, I've done a midpoint between the 50 and the 65. I've actually just used a fib at 61.8 or whatever that is, but give or take. But it's basically in the middle of the 75% and the 50% retracement. As it crosses here, in this example, you're going long as it crosses there, and your stop is going here at the 50%, and your target is at the 100%. So it's a very mechanical, very systematic, very simple to execute trade. So as the price crosses back over here, you're long here at 10,975. Your stop is at 10,965. So in this case, it's 10 points, and your target is 18,007. Or if you fancy being a bit brave, quite often we just push through and take it out by a few ticks. But either way, you can either go 1 tick ahead of it, or you can go a couple of ticks behind it. I think both are pretty feasible. So you've got a decent risk-reward ratio there if that's your thing, which it is should be for most people. And also, you've got a good percentage probability of it working, because this has worked quite a lot. If you go back and look at all the announcements where nothing really happens, then this is kind of what happens. And the good thing about it is that the stop becomes dynamic. As the market moves wilder, the stop becomes wider as well. So as you get more range, the stop becomes larger to accommodate that range and volatility, and so with your targets as well. So, and that's why it's good, because it's so systematic. You don't have to think about it. Your stop is what it is. There's no thought about where will I come out. It's just a pure systematic play. Thesis being, once it's overtaken that level, it's basically going to push back up and retest that high. So that's kind of the way to approach it. I quite like doing that. I think it's quite good. How much longer will it last for? I don't know. Obviously, if the market goes blasting off into the stratosphere and carries on going for an hour or 15 minutes, then you're not doing this. You're doing this within a sort of 5 to 10 minute window, assuming that the reversal is going to happen. So, and it's like a non-event situation. If it's a real event and there's something unusual comes out, the market's just going to blast off, and you're using a different strategy for that. So anyway, just thought I'd share that with you. That's worked again on the FOMC yesterday, as it had with a couple of other bits and central bank announcements the last few times. So how long will it last for? I don't know. Maybe this will be the last time it goes. But it's a good kind of way of gauging things anyway. So hope this has some use. I hope you had a great trading day today. Back with another video tomorrow. Take care.